The genesis of credit benchmark and the problem that we were trying to fix was a really, really big problem. Any one of us old enough to be around the scene of the 2008 global financial crisis will never forget it. And it became quickly apparent that there were many, many things wrong with the system, but one of the things that was materially wrong with the system was the accuracy, efficiency, efficacy, if you like, of credit information. And the best way to summarize what the problem was would be to recommend Michael Lewis's book, The Big Short, and to watch the film of the same name. That's the problem we were trying to sort out. It was that big. Basically, we believe that there needed to be a better way of providing the markets with accurate, actionable credit intelligence. Not to be a rating agency, not to go down that proven path, but a different way, a better way of addressing the problem statement, which is people want to understand for good risk reasons, good business reasons, political reasons, regulatory reasons, capital management reasons, the likelihood of the counterparts that they're doing business going bust. And that one way of doing this was to get the counterparts to pay a rating agency to rate them. And in 2008, that was one of the component parts of the system that unraveled. And we believed that we could provide a better solution. And that solution lay in a business model that Donald Smith and I, my co-founder, had established and demonstrated to be useful in the world of securities finance. I founded Data Explorers with Charlie Stopford Sackville, and Donald came on board in 2008. Great timing, Donald. And we continued to work together until 2013, by which time we really knew that we enjoyed working together, and we thought that the contributed database business model that we had built and scaled at Data Explorers was transferable to the credit space. If we could whisper data out of the largest, most sophisticated supervised banks in the world, clean it, make it comparable, we could provide consensus credit ratings that would help them, help their customers, help the system. That was the fundamental idea. Watch The Big Short. We had spent 2 years persuading 3 banks to send us the data necessary, the 1-year probability of default, the data necessary to create a consensus. You need 3 data points. The third bank to arrive said, that's great, but we're American. We need safe harbor protection as well. So we need 5 banks giving, 3 of them giving data on one particular credit, then we're in. It took us another 6 months to get that 5th bank, but we got there. And the celebration moment was this. They sent in data. We made sense of the data. What would it tell us? It told us that we could get data. It told us that we could concord data. It told us we could create a consensus for the princely sum of 268 consensus credit ratings. It was a beginning. I turned to Tom Aubrey, with whom we still work, and hi Tom, and said, what's it look like? Is it interesting? And Tom, in a rare moment of hyperbole said, Mark, it's not interesting, it's bloody fascinating. The banks don't agree with one another. There is a range and a diversity of opinion. Check. They change their views. We had a time series at different times. Check. And they don't agree with the credit rating agencies. We had informational value. We had something really unusual, really special, really valuable. Fast forward to today, 17 GSIBs, 40 banks sending us information, 120,000 consensus ratings. But that was the day that we knew we had information of value and utility. That was the foundation. It took us 2.5 years to get there. It wasn't a huge effort, but Tom realized it, I realized it, and our colleagues realized it. It was an amazing moment. It has, from my vantage point as a non-practitioner, non-expert, but a curious student of credit risk, yes. I remember immediately prior to COVID in the sort of November, December run up to the year end, people were talking about the credit cycle kicking back in and it was turning and everything. And then COVID dominated the conversation, and there was a panic in every way because of the unprecedented nature of the circumstances, and a real concern that credit risk would really manifest itself. And to the immense credit of the governments and central bankers of the world, they flooded the world with liquidity, and credit did not manifest itself. It moved from being a cyclical problem into a benign situation, which one could argue is possibly still the case today. Very few material credit defaults happening. Pressure building, and it feels like there's a kind of concern now. We all saw the recent Bloomberg article on Fox Hedge, and I think for some people that I listened to yesterday talking about it, it felt a little bit like the household HSBC moment in 2008. I hope I'm wrong. But so the answer to the question is about over the last 10 years, how things have changed. It's like we've been, broadly speaking, in a prolonged benign credit environment, which has meant that some firms have taken their eye off of the credit risk ball. And notwithstanding a fascination with private credit, shadow banking, and the transition and moving of credit around the board, around the financial markets, it feels like banks are taking less credit risk. The private market, shadow market, is taking more risk. And that means that the information that we have is really pertinent, not just to banks, but to insurance companies and private investors in the credit market. So over the last 10 years, credit risk has moved, not gone away. And I think there will be a return of the credit cycle. And where those risks and defaults land will be very, very interesting. It could be different from in the past. A bank, for the regulatory supervisory oversight that they feel and the capital they have to put to work, etc., have to be quite transparent about their realization of credit risk. Maybe less so in the private banking. Will they renegotiate and extend? Is there a word of sort of almost like covenant light occurring in the credit markets, which will change the credit markets? I have a weakness for books on business. I have a weakness for economics, and I have a weakness for the importance of weakness. I have a susceptibility for reading about these kinds of things and these questions. I do genuinely believe that culture is how you behave when no one's looking. So from a personal perspective and a business perspective, nothing has changed. We were determined to find and establish a business that was confident, capable, culturally aligned with the best interest of its customers. And I don't think we've erred from that one bit. Maybe we've taken longer to do certain things. Maybe we've been, slow to adapt in certain things, but we've come through some immensely difficult times in the world, not just for us, but for everybody. And, it's a thing that the answer being nothing is probably not very interesting, but I think it's broadly true. I don't think that the culture of this firm has really changed one iota. We want to deliver the firm, the best of the firm, to our clients. We want to be trusted. We want to be capable, confident, technologically literate, compliance literate, legal literate, data literate, all of these things. So nothing. It's probably the rather strangely named COVID Commercial Funding Facility, and our input into that to assist the Bank of England during the time of COVID. Donald got a call, I think on a Friday evening, from one of the private secretaries in the Treasury. And within 48 hours, we delivered data to the Bank of England to help them understand the creditworthiness of the hitherto unrated multiplicity of companies in the UK that had not paid for a traditional credit rating, but where we had a material, credible, deep consensus credit rating. And as a Liverpool fan, I'm devastated to say that we were able to support some of the building programs for other football teams. The modesty and confidentiality prevents me from saying which ones. But our data as part of a process really did help assist companies that didn't have a credit rating access vital lending, borrowing capacity, credit lines from the Bank of England. And that's a pretty big deal. And that's something to be very, very proud of. I was at Goldman Sachs many years ago, and one of the partners used to be fond of quoting the B-52s, the band. Check out B-52s. Rock Lobster, you probably know, but there's a song called Don't Let It Rest on the President's Desk, Rock the House. I would like us to maintain our slightly quirky, irreverent, creative capabilities and to do things that people think are impossible. I'd love us to be able to be recognized as an important component part in the credit environment. I'd like us to become embedded and recognized as a valuable source of different kinds of information. The creation of a consensus is a very challenging thing to do. We have not finished. One of my colleagues once said that we'd hit critical mass, and I know exactly what I thought he meant, and I know what he meant. I would take it slightly different. We will never, ever hit critical mass. We will always want more data, more information, so that we can drive the centrifugal force of the data business and develop the sort of centripetal force delivering utility to our customers. I'd like to think that that we won't let it rest on the president's desk, and we will rock the house.